up, interwebs, how's it going? So over the last couple weeks, there's been a lot going on in the tech world. So first off, Twitter launched its IPO and raised $1.82 billion. Then after that, rumors started floating around that Facebook wanted to buy Snapchat for $3 billion, and then that Google wanted to buy it for $4 billion. Yeah, that's right, billion, with a B. So in addition to seriously making me question my career choices, hearing all this news got me thinking. A lot of people probably hear these numbers and terms floating around and have no idea what they mean, which is understandable. But wouldn't it be great if someone could teach these people what these things meant, so that next time they hear all this stuff, they actually know what's going on? Then I thought, why not me? I know what's going on. Plus, it would finally give me a chance to actually use all those finance classes I took in business school. So that brings me to my new, and possibly recurring segment, Mike University. So named partly because I'll be teaching you stuff, and partly because it appeals to my narcissistic desires to have a university named after myself. So let's get started. First, to really understand what's going on, you need to learn what stocks are. So let's say you have some for-profit business. Really, it could be anything. Whoa, hold on a second here. Mike University is a not-for-profit institution dedicated to the higher learning of the online community. That's better. But if we're in a hypothetical scenario, why not go big? I'm just pulling ideas off the top of my head here, but maybe we could go with something like a company that has a captive customer base with little to no alternatives in the market, which not only allows the company to gouge its customers with artificially inflated prices, but also allows the company to make completely arbitrary changes to its product, thus making the previous product completely obsolete and worthless, thus making its customers buy a new product every year. There we go. That's better. So there are three basic types of companies. First, you have your sole proprietorships, which is where one person owns the entire business. These are your mom and pop stores, your local restaurants, stuff like that. Then you have your partnerships, where ownership is divided among a few individuals. A lot of times these are things like accounting practices or law firms. So if you ever fast forward through your commercials and you see an ad for Lieberman, Horowitz & Klein, attorneys at law, that's a partnership. Lastly, there are corporations, which is what most people think of when they think of a business. These could be anything, like giant corporations like Toyota or Apple or ExxonMobil, to small companies that only have a few employees. Now, ownership of a corporation is divided among a group of individuals who are called shareholders. All of the shareholders split the ownership of the company through stock, which are ownership rights to the company. Each shareholder owns a certain amount of shares, hence the name, which are units of ownership. The easiest way to think about it is to think about the company's total stock as a pie. This is a pie, in case you're confused. Stop judging my graphic design skills. And each piece of that pie is a share of stock. Now obviously, a share of a company that divides its stock pie into 100 pieces is going to be worth more than one that divides it into, say, 1,000,000 pieces. But regardless, a share is a share, and each share represents ownership in the company and a say of what happens in it. Now sometimes a company will want to raise money to expand or hire new people or what have you. Now a lot of times when companies are new, what they'll do is they'll approach investors to invest money into the company, and in exchange, the investors will get a chunk of shares. So what does it mean when you hear a company like Snapchat has a valuation of $3 to $4 billion? Well, typically what happens is the investors who are approached will look at the company and its income and its costs and its growth potential, and they'll decide to invest a certain amount of money for a certain amount of shares. And based on that investment, you can calculate what the company's total valuation is. Say an investor gives a company $1 million for 10% of all of its shares. That means the whole company, or 100% of its shares, is worth $10 million, or 10 times the investment that was made to get 10% of its shares. It's as simple as that. So how did Facebook and Google decide that Snapchat, a company that makes literally no money whatsoever, was worth $3 to $4 billion? Well, if you ask me, it sounds like Mark Zuckerberg and Larry Page pulled those numbers out of their asses, but that's just me. They might know something that I don't. So eventually, a company like, say, Twitter will get to a point in its life where it wants to raise a really big investment, bigger than one that they could get shopping around to individual investors. So then they'll decide to sell their shares on the stock market to the general public. When the company decides to do this, they'll work with an investment bank, which I guess in this analogy that I'm using would be a professional pie salesman, which will help them make the necessary preparations, like how many shares to sell, what price to sell them at, what stock market to list them on. Once they have everything prepared, the company can announce its IPO, or Initial Public Offering, which is the name for the first time the company offers its shares to the general public. To continue with our analogy, the company and its pie salesman will go into the market with a certain amount of shares that people can buy at a certain price. Once all those shares are sold, the company can take the money it raised from selling all those shares and leave the market and go do whatever it wants to do. And the people that bought those shares can do whatever they want with them. They can hold on to their slice of the stock pie and hope that it gains value in the future, or they can go ahead and sell it to someone else right away. And that concludes today's lesson. Now that you've watched this video, the next time that you hear Facebook or Google wants to snap up the next hot social network, or when Pinterest or Dropbox or some other tech company announces its IPO, you can totally look really smart in front of all your friends and tell them exactly what that means. Guys, if you like this video, let me know by hitting that like button or leaving a comment down below, maybe about something you'd like to learn about in the future on this segment. As always guys, thanks for watching, and I'll catch you next time.